right, so notice at the top we've got assets, liabilities, assets equals liabilities plus equity. That's the accounting equation that we learned last class. Under assets, we've got 3 accounts: cash, supplies, and land. And those are the only 3 assets for this company, this business. Liabilities, he has 1 liability, which is accounts payable. Liabilities are debts, obligations. And then his equity account is Chris Clark Capital. We call the equity account capital. And he's the only owner. So if there's just 1 capital account, if there were more than 1 owner, we'd have another column for that owner. This is just going to get you into the accounting mindset that every transaction affects the accounting equation. And after every transaction, you'll be able to see that our accounting equation is balanced. It's going to stay balanced. So every transaction we do, whether it's pay our employees, buy land, buy supplies, make a sale, pay a debt, sign a mortgage, anything that the business does can be put in terms of the accounting equation. So the first transaction, it's at the bottom of page 10. November 1st, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions. So he took his personal money and he put it into a business account. So he's contributing this money to the business. So the cash of the business goes up because he put money into their bank account. His equity, his capital goes up because we're going to give him credit for that contribution. So what we're going to do is plug in $25,000 under cash, and we're going to plug in $25,000 under equity. So if we looked at our accounting equation, assets of $25,000 equals liabilities of 0 plus equity of $25,000. So our accounting equation balances. Remember, this can be considered the same thing as net worth. Okay, so right now the business is worth $25,000. That's what they've got in the bank. They don't own anything else. They don't owe anything. That's it. If he were to walk away today, he'd just get his $25,000 back out of the business. Do what? Yeah, well, so he's hoping to grow it, and he could walk away with a lot more than that. But next thing he did, he purchased land. So November 5th, paid $20,000 for the purchase of land as a future building site. So what happened to cash? Went down by $25,000 or $20,000. So we're going to subtract $20,000 from cash. But then what happened to land? It went up by $20,000. He doesn't owe anything on it, and equity is unchanged because remember, equity changes only with revenues, expenses, investments, or withdrawals. So he didn't invest any more money. He didn't withdraw any money for personal use, and he hasn't made a sale or incurred an expense. So he purchased an asset. So if we got a total here, we would have cash of $5,000 is the balance, land $20,000, and equity $25,000. So our accounting equation still balances. The left side, it's got 5 in cash, 20 in land, so $25,000, and then the equity is still at $25,000. November 10th, Net Solutions purchased supplies for $1,350, agreed to pay the supplier in the future. So this is going to be what account? Supplies, and what else? Liability. Okay, accounts payable, because he said, I'm not paying it today, I owe it to you. I pay it later. So supplies, what is it, $1,350? Okay, so supplies goes up by $1,350, and liabilities goes up by $1,350, because we're keeping up with the amount that he owes to everybody. Okay, so we get totals. If we get another set of totals, we still have the $5,000 in cash. We've got $1,350 in supplies now. We've still got the land. We now owe a debt of $1,350, and equity balance is $25,000. So if we added up the left side, added up the right side, we would get $26,350 on both sides. So our equation balances. On the 18th, they received cash of $7,500 for providing services to customers. So he made some money. He made revenue. He made a sale. So which accounts are going to be affected here? Okay, cash. And what else? We can put in the $7,500 cash. Let's say $7,500. Okay, he had that. What else? What else? Where would we put revenue on here? What would that? Would that increase his net worth? Okay. Let's add it over here. All right. If we get totals here, we're gonna get $12,500. We still got the supplies. Still got the land. Still owe the debt. And now capital is $32,500. Okay, so if we added up left and right side, we would get $33,850 on each side, and our equation balances. Next transaction, he paid expenses, wages, rent, utilities, and miscellaneous. So he's writing checks. He's paying things. So what's going to be affected here? Okay, well, he's not paying off his debt yet. That's next, I think. He's paying bills. Okay, cash is going to go down. Said he paid $3,650 total. That was a total of wages of $2,125, rent of $800, utilities of $450, and miscellaneous of $275. So we're going to subtract them from cash. We're also going to subtract them from equity. So the wages, $2,125, utilities $800. No rent. Let's see. Rent was $800. Utilities $450. And miscellaneous $275. If we get new totals, we now have $88.50 in cash. Still have supplies. Still have land. Still have debt. And now our equity is down, or his equity is down to $28,850. So if we add up both sides, we still get the same amount. You could have put these separate under the cash. You could have done that, but let's put the total amount. In a journal entry, which we learned in chapter 2, we'll put the total under cash. This is one big entry. So either way, still get the same balances for the accounts. The next one, he paid his creditor. Paid off the credit card or the store credit or whatever he set up for those supplies. And he paid $950. So which accounts are we going to do there? Cash, we're going to make it go down by $950. And liabilities, should I add or subtract it? Okay, subtract it, $950. Okay, so that'll leave $7,900 in cash. Still have supplies, still have land. We now owe $400 on the credit card or the debt. And our equity remains unchanged. So if he were to walk from the business today, after he paid that credit card payment. He said, look, I can't do this anymore. I want to go out of business. He's going to walk away with $28,850. What he's going to do, he's going to sell the land, take that $20,000, put it in the bank, sell the supplies, take them back or whatever, $1,350, put the $7,900 in the bank, and then he's going to subtract out $400 to pay that debt. The remaining amount would be $28,850. So that's why it's called net worth, because that's the difference between assets and liabilities. So he would take everything he owns, subtract off what he owes on them, and then he'd walk away with $28,850. You could do this for your own personal household, yeah. You'd say, what if you died? How much would you leave? What are you worth? How much would your kids or your spouse get? Well, you take what you own and you subtract off what you owe, and whatever's left over, that's your worth. So, and it could be negative. Okay, it can be negative. You could owe more than you own. You could owe more on your asset than you have equity in it. So, all right, the next transaction, he determined that the cost of supplies on hand at the end of the month was $550. So what's happened here is he bought the $1,350 worth of supplies at the beginning of the month, and he spent some of it, or used. So he used some of it. He used the paper and the pens and the ink cartridges and whatever supplies, toilet paper, who knows what it is. And he counts it up at the end of the month and says, I've got 550 left. So I need to subtract out 550. Whoops, nope, not that. Subtract out 800. We want this balance to be 550. Let's see. We want our balance to be what we actually have, which is 550. So we need to subtract out 800. He used $800 worth of the supplies. We're also going to subtract it from the equity because it's an expense, supplies expense. Okay, if we get our balances, still owe the debt, still have the land, and still have the same amount of cash. So if we add up both sides, we get $28,450. And our equation still balances. So no matter what we do, we can put it in terms of the counting equation that's going to remain balanced. The last thing that happens, he takes out $2,000 for personal use. So it's to buy his son a car or something. It has nothing to do with the business. He's the owner. He can take out money whenever he wants to, as long as it's there. So what's going to happen here? Okay, equity and cash, so take out $2,000. So he's got $5,900. Still got the supplies and the land. Still owe the debt. Oops, we need to take out $2,000 over here. So now we got $26,050. So his net worth went down because he took out money. Right. So his net growth for that, you can call it that, was $1,000. His increase in the amount of his business was $1,050 for that month. He made some money, made $7,500, but he also spent money. Okay, any questions on this? Now let's take these numbers and let's make some financial statements for this business, for this 1 month. I think I need to add some slides here. Alright, so this was for November 2011. For the month, he started November 1st. And if we think back to our layout for financial statements, the first one is the income statement. Do y'all remember what goes on the income statement? What minus what gives you net income?
It's your assets minus your liabilities.
Nope, not that one. Revenues minus expenses gives you net income. Alright, so we're going to put revenues. He had that $7,500 revenue, and I'm going to do it. I'm just doing the kind of shorthand version here just to get the formulas out there. So we're going to do the revenues minus all the expenses to give us net income. The second one is a statement of owner's equity. We're going to put his beginning capital, which was 0 in this case because it was the first month. Add investments. He had $25,000 investment. Subtract withdrawals. He had a $2,000 withdrawal. And add net income. And that's going to give us ending capital, which should be the $26,050. That was his ending on our little spreadsheet. Okay, and remember that this flows through to here. Okay, so those, you got to get the income statement right to get the statement of owner's equity right. All right, and the last one is the balance sheet. And we're going to have assets. We're going to list those out and get a total. And then we're going to have liabilities and equity. List those out and get a total. And these will balance. So we should get on each side $26,450 on each side there. That's what we ended up with on our sheet.
Where's OE?
Owner's equity. Okay, so the capital flows through down here because we're going to add it in with the liabilities. So again, you got to get the statement of owner's equity right because it flows through to the balance sheet. Also remember, you got to do this one first, this one second, and this one last. Always have to start with the income statement first. As a student, I always wanted to start with the balance sheet because I knew that one. I knew it was the accounting equation. I knew what assets were, and I wanted to do that one first. So I would start doing the balance sheet. And it wouldn't balance because I didn't have the right capital in there because I can't use beginning capital of 0. I got to have those numbers from the statement before. So you got to do the income statement first. Okay, so income statement, we're going to do revenues minus expenses. We're always going to start with a heading for our financial statements. The company name, the statement name, and date. Okay, that's just a standard heading for all of your financial statements. The income statement and statement of owner's equity are going to be 4-month ended because they show the activity within that month. We're going to show what happened from November 1st to November 30th only. When we get to the balance sheet, you'll see that these words are not there. We only have the date, November, because the balance sheet shows as of November 30th. That's what we own. That's how much cash we have, how much land we have, how many debts we owe. And those could have been gained by the business years ago. So it's not just for the month. So keep that in mind. All right, so the first thing we're going to put is fees earned. This is also a revenue. Okay, so this is a revenue account. We call it fees earned because he's a service business. When he makes money, it's not necessarily, we can call it a sale, but generally merchandising businesses call it a sale, and service businesses will call it fees earned. And he had $7,500. He made that one sale back in transaction D. Then we can list our expenses. Okay, we're going to list them largest to smallest, and miscellaneous is always last. Okay, so largest to smallest with miscellaneous always being last. So the largest would be wages. Then we have rent expense, which was $800. We also have supplies expense. Don't forget that one down there in transaction G. So we'll put that next because it's $800. Then utilities. And miscellaneous. Miscellaneous happens to be the smallest, so it's last, but even if miscellaneous were $1,000, it'd still go last. It should be the smallest because that's just for the little leftover stuff you don't want to create a whole account for. If it's a significant amount, you probably want to go ahead and make an account for it. So I think they said this was for a magazine subscription and postage in this example. So let's get total expenses. Anybody got a total yet? 4450. Okay, what does that make net income? No, 3050. These financial statements, by the way, are on page 17. I forgot that they were in this chapter. So, we can check ourselves. 3050. Okay, so we got fees earned minus expenses. So revenues minus expenses gives us net income of 3050. And we've got to remember that number because we're going to use it on the statement of owner's equity. Any questions about the income statement? No cash on here, no supplies, only revenues and expenses.
You're minusing 4450 from 750, right?
7,500.
I'm 7,500. Okay.
Yep. Okay. Statement of owner's equity next. Put net solutions at the top. Statement name. And the date. We start out with beginning capital, and it was 0. This was the first month of operation for this business, so we started out with 0. If we add his investments, he made one investment of $25,000. First thing he did, put his personal money into the business. He took out $2,000 at the very end of the month for his personal use. So we subtract that out. And then we add in net income from the income statement, $3,050. So we get ending capital of $26,050. That's what we had on our spreadsheet. So you can check yourself with your spreadsheet and make sure that was the same. Notice that mine's pretty simple. My statement of owner's equity is simple. If you look at the one in the book, it's got indentions and subtotals. I don't really care about format. Do it however you want to do it. Indentions or whatever. As long as you get that bottom number, $26,050. I don't really care what it looks like. Now, if you're an accounting major and go on to other accounting classes at another school, then your instructor or your professor may want you to have a specific format. But I don't care, because each business is going to have their own way of doing it. If we pulled up those annual reports, and every business is going to be a little bit different. Even what names that they have. They may have different accounts for the same thing, but different names for accounts. So I just want you to get the bottom line and know the formula for it. So we're going to keep this number in mind, use it on the balance sheet, which is the last financial statement that we do in this class. The statement of cash flows is done in accounting too. Okay, and we don't have 4 months ended on the date. We just have the date, just the month. As of, you may see some put as of November 30th, 2001. Okay, you can do this as one column, or you can do it side by side in 2 columns. I like doing it in 2 columns because you can compare the number at the bottom. You don't have to look for one number halfway down and then find another one. So I like to do it side by side, and in the book they do it side by side as well. The assets, he had 3 assets. He had cash, supplies, and land. And by the way, these are listed in order of liquidity. Well, there we go. Okay, what does liquidity mean? What does liquid mean?
Liquidated.
Okay, what does that mean? Okay, used or sold. Okay, turned into cash. So we list these in order of liquidity. Cash is always first because it's already cash. And then we'll put the more current assets, inventory, supplies, accounts receivable, put those things, and then put the fixed assets, the long-term kind of assets that it'd take a while to sell them. Land, vehicles, machinery, buildings, things like that. So his cash balance was $5,900, supplies balance was $550, and land was $20,000. And think back to the Chapter 1 lecture. Land is recorded at its cost. All these assets are recorded at their cost. So this land could be worth $50,000, but we listed at $20,000. So that can be somewhat misleading, but that's the rule we got to follow. So $26,450 are total assets. Liabilities, he had accounts payable. It's the only one he had. And he still owes $400 on it. And then we pull over the equity. Chris Clark Capital, or ending equity of $26,050. Okay, so we balance. Woohoo! Hey, we don't have to go back and figure out where we messed up. If you don't balance when you do a balance sheet, the best thing to do is check your calculations first. Make sure you add and subtracted correctly. The next thing is make sure you didn't forget an account. So I would check off, as you have your list of accounts, you can check off the ones you've already put on a statement. So you will balance If not, there's a mistake either in the journal entry itself, or sometimes even if you make a mistake in the journal entry, you'll balance. So, anyhow, questions on this? We took all those transactions and now we have financial statements. Okay. If he were to walk away today, he'd walk away with $26,050. If we looked at his bank account, he'd have a balance of $5,900 in it.
Now, if they sold the company and the land sold for more,
What would happen is you would, your cash would go up by say $50,000, and your land would go down by $20,000. So the net of $30,000 would be added to the equity. So you'd have 30 and 30 on each side.